Welcome back to our series on Introduction to Financial Services Industry. We're now going to start talking about fixed income products. And I had to break this up into 3 or 4 different videos because there's so much material to cover, and I can only have videos that are 15 to 20 minutes. So let me get into this right away. Again, the same disclaimer I always do. This is a presentation for people who just want a high level review. So fixed income products or debt products, sometimes you'll hear the term fixed income used. Sometimes you'll hear it referred to as debt products. Different firms, different people use different terminology, but they both refer to the same thing. A fixed income means the investor is going to put up a principal for the purpose of generating income. And that income comes in the form of coupons or interest payments or dividends or whatever. And the same thing is, they're also called debt products because the issuer of the security incurs a debt. The issuer issues the security in return for a principal, a capital investment, to which they then have a debt to repay the principal with interest or dividends or coupons or whatever. All right. So again, the term fixed income, term debt products, you'll hear them both used. They both are referring to the same thing. So as I said before, the investor pays a principal. Now, most of these are what we're going to call bonds. Let's take fixed income, and for the purpose of the conversation at this point, let's talk about bonds. Bonds are fixed income products. They're debt products. So an issuer, someone issues a bond. That someone could be a corporation. It could be a government. It could be a municipality or some other authority, the New Jersey Turnpike Authority, or some government associated or some authority. So there's lots of different people. They issue bonds. So they're borrowing money. They're borrowing the principal, and they're going to pay it back with some interest. So that principal is usually the face value of the bond, but not necessarily. We're going to show you an example where it's not, where the investor puts up that principal at face value, and in return, they're going to get back interest payments or coupon payments or some accrued interest. And the issuer has an obligation to repay this bond at maturity and also repay all the principal. Now, let's just give you the simplest example. In this case, the principal is $10,000 and the face value is $10,000. So here's a bond where the investor put up a principal of $10,000, face value is $10,000. And in return, the issuer agrees to pay a certain number of coupons or interest payments or dividends over the life of the security to maturity. And at maturity, when you hit the maturity date and all the interest or coupon payments have been made, the investor will get back their principal. That's one type of bond. That's a very common type of bond. Now, there are other types where the investor gets paid back the principal as part of their coupons, but we're going to talk about those a little bit later. Now, here's another type of bond. This is the exception where the principal is less than the face value. The best example of this is you buy a $50 savings bond. The issuer is the U.S. government, the U.S. Treasury. The face value of the bond is $50, but you don't pay $50 to buy a U.S. Treasury bond. Not U.S. Treasury bond. You don't pay $50 to buy a savings bond. You buy the savings bond, and at maturity, you get back $50, right? That's another example. So there are other examples where the investor puts up a principal less than the face value, but as the interest payments are accrued over time, it brings the bond up to the face value. So those are two examples. Again, first example is where the principal rate, the principal that the investor puts up, the money the investor puts up, and the face value are the same, in which case the investor would get interest payments or coupon payments over the life of the investment, and at the end would be paid back their principal. Or a case where the principal that's paid is less than the face value, but over the life of the security as it matures, interest payments would come in, and at the end, the end face value would be achieved and paid back to the investor. So those are just two examples, but they both point to this thing that is very hard to value a bond because it depends upon a lot of things. It depends on market factors, and it depends upon what's happening in the market with interest rates, but it also depends upon what's the current age of this bond. So for example, if you have a bond and the principal is $10,000, the face value is $10,000, and it pays 6% interest, and this bond has none of the interest has been paid yet. So all the interest rates, all the interest payments and coupons are still not paid. They will be paid in the months ahead. They'll be paid in the future. Okay. So as we go through time, the interest payments get made. But when half those interest payments have been paid, the bond is no longer valued the same as it would have been when initially issued. Because at that point, half of the interest that's going to be derived from this security has already been paid, and the remaining payments are yet to be paid. So that it only has so much value remaining in it. So investors have to take this into consideration. Now, obviously, if there's only a few payments left to be made, it would be valued less than if there's a lot of payments to be made. If it's only it only has a one or two coupons been paid. As it matures and reaches maturity, it could reach a point where there's only one payment left, right? So the bond's value would have to be, okay, the value of the principal and the value of that one remaining payment. Now, again, you have to also take into consideration other factors like, how risky is this bond? How does it compare to other bonds in the market? What's the interest on this bond? Is this callable? Has it been called already? Is it paying 10% interest when the prevailing rate in the market is 2%? There's a lot of things to be considered. But the point is, it's hard to value it because value is determined as a spot in time regarding the life of this bond. And the other same example here, if you had a bond that had a face value of $10,000 and the principal has already been paid, the principal is less than $10,000. The value, it would have different value based upon how many interest payments are remaining. So this whole topic about valuing bonds brings me to what I talk bond calculators. Bond calculators are very sophisticated software that are used to compute the estimated value of a bond at any particular point in time. So what sophisticated institutional investors do is they use these very complicated bond calculators that can figure out what is, based on what's happening in the market, based upon the current date, what's the maturity date of the bond, what's the, what are all the attributes of the security. They can figure out what is the estimated value of the bond in the market as of that point. And bond calculators, like I said, they look at the par value, which is the face value of the bond. They look at the market price, which may be above or below par value, right? Because this bond could be paying less than the prevailing interest rates, or could be paying more than the prevailing interest. So if you have a bond that's paying 8% and the prevailing interest rate is 6%, well, 8% obviously is more desirable than 6%. So there's a lot of things that the calculator has to consider on the par value. They also have to look at what's the settlement date, what's the maturity date, and what's the yield. The yield is the income return on investment. This refers to the interest or dividends received from the security and is usually expressed annually as a percentage based on the investment cost, the current market value, or its face value. So there's a lot of things to be considered here. And then there's the redemption value, what's going to be paid back at maturity. Now, I put a link in here to investopedia.com, calculator bond price, because as I've said earlier, it is very complicated. And I think Investopedia is a terrific source. And if you go there, you can get a better, a more detailed description. So we're talking about bonds here. And I want to take a second to talk about some of, but not all of, the different type of bonds that are available in the market. So the first one we've kind of talked about a little bit, fixed rate bonds, right? A fixed rate bonds have a coupon or interest or dividend, right, that remains constant through the life of the bond. Let's say this is a 6% bond. So it'll have a coupon or a dividend payment or interest payment. So that throughout the life of this bond, each of the payments is going to be 6%. You're going to get paid 6% on this bond. That rate doesn't vary through the life of the bond. Now then there's what's called floating rate notes, FRNs or floaters. And they have a coupon or a interest rate or a dividend that is linked to a outside reference rate, such as the LIBOR or the Euribor or some other outside indicator. And as that changes, the rate of return, the rate on the coupon, the rate on the dividend will change. So maybe it starts out as a 6% bond, but as LIBOR goes up, it becomes 7%. Or if LIBOR goes down, it goes to 5%, right? And usually the bond will have information that says it'll guarantee that it won't go below some percentage, some rate, or won't go above some rate or below some rate. But you have to read carefully the description of details. All that underlying descriptive indicative data for the security will tell the sophisticated investor all the details. But the point here is the rate will float. The rate of the return on these bonds changes as other indicators it's fixed to. These are great when you're in inflationary times, right? So as there's inflation, as the LIBOR rate goes up, the return on those coupons will go up. So that'd be good for a senior citizen or somebody who's looking for that type of return. Now, there's also zero coupon bonds. I talked about this before. These are cases where there is no interest rate. It's not paid as, there's no interest rate paid. They're issued at a discounted value so that the interest is effectively paid at maturity. So this would be the example of a savings bond. You know, you buy your nephew a $100 savings bond for his baptism, and you know his family cash. It costs you $50 to buy it. When it fully matures, your family member takes it to the bank. They cash it in, and they get paid back $100. They get the face value. That would be an example of a type of zero coupon bonds. And there's other zero coupon bonds, but the point is there's no interest rate paid. The interest rate is based in the face value return at maturity. And then there's high yield bonds, or commonly called junk bonds. I despise the term junk bonds. They always talk about Michael Milken. These are bonds that are rated below investment grade by credit rating agencies, and they have really good returns. They have high rated returns. They have a high yield. So when your very safe, highly rated bonds are returning 6%, a junk bond might be returning 9, 10%, right? The reason why I say I hate the term junk bonds is almost everybody who listens to this video has a cell phone in their pocket. And how were cell phone towers built? Cell phone towers, most of the cell phone technology in the country was built by Verizon and other companies, Sprint, selling junk bonds. They sold junk bonds so they would get the money to buy the land, hire the construction, build the cell phone towers. If they had not been able to buy junk bonds, sell junk bonds, if they had not been able to borrow money through the sale of junk bonds, they never would have been able to build the cell tower infrastructure in the United States that we have today. So yes, junk bonds, they can be high risk, but they're a higher reward. And that's really what we should keep in mind. It is a higher risk, but it's a higher reward. And then there's convertible bonds. A convertible bond lets the bondholder exchange the bond for some number of shares of the issuer's stock. So a convertible bond is a bond that, let's say you have a corporate bond issued by a private corporation. A convertible bond at maturity would let the investor convert the bond to shares of stock. This is a hybrid vested, and they're usually combined with other strategies. Now, then there's exchangeable bonds, which are kind of similar, but they allow for the exchange to shares of a corporation other than the issuing company. So whereas we were talking before about convertible bonds, company X issued the bond, and they give you the option of converting the bond to shares in company X. In the case of exchangeable bonds, company X issues the bonds, and they allow you to convert to shares of company Y, some other issuer, some other security product. So that's exchangeable bonds. Inflation index bonds, we talked about this a little bit more. They're also called linkers or index-linked bonds in the UK. And this is a case where the principal amount and the interest payments are indexed to inflation. And this is the case we talked about before with the LIBOR. So as inflation occurs and the inflation rate increases, the interest rate payments to the bond would increase. I would also presume that as inflation goes down, well, I never see this, it never seems to go down, but as it goes down, the interest rates will go down. Again, it's a safe fixed income product for someone who's afraid that they're going to put their money out and that there'll be high interest rates, high inflationary economies that will eat up any profits on their dividends and their coupon payments. Asset-backed securities, I'm going to talk about this later, but basically there's a lot of different types of asset-backed securities: collateralized mortgage obligations, collateralized debt obligations, mortgage-backed securities. There's lots of these, but basically these are bonds. These are bonds whose interest rate and principals are backed by some underlying cash flow or other asset. So this is the case where someone like a mortgage-backed security where they're going to sell you a bond and it is backed by a package of mortgages and the interest rates and that will be paid through the income from those mortgages. Now, it's not always home mortgages. I mean, it could be they could be packaged as mobile homes, or they could be packaged as some otherwise collateralized debt obligations or mortgage applications. I've seen that people have created securities that are backed by credit card debt, or they're backed by car loans, car debt. But typically, the easiest example to understand of asset-backed securities are bonds that are backed by an underlying asset, like a mortgage, where there's a debt obligation for somebody to pay the mortgage, or pay the credit card debt, or pay the car loan, or pay the RV loan, right? And that's the underlying asset that's providing the income and the revenue for the interest payments and the principal payments. So that's asset-backed securities. There's an asset backing the security. Subordinate bonds are those that have a lower priority than other bonds. Bonds of the issuer in liquidation. So this is a case where corporations will issue subordinate bonds, but in the case of a bankruptcy, these would be paid later than other bond obligations. They'd be subordinate, meaning below other bond obligations. So if there was a corporate bankruptcy, the other bonds would be paid first before these bonds get paid off. Covered bonds are backed by cash flow from mortgages or other public sector assets. Perpetual bonds are often called perps, perpetuities, and they have no maturity date. These are bonds that never mature. You put up the principal and they just keep paying interest forever. They never mature. You only get the principal back when you sell the asset. Bearer bonds. We don't really do these in the United States anymore. These were certificates. These were bond certificates that used to be issued, and they had no name on it. And so they were no registered owner, and they were as good as cash. If you had a $10,000 bearer bond, it was the same as having $10,000 in cash. U.S. corporations stopped doing these, and the Treasury stopped doing these. And the reason was they were too easy for them to be stolen, and the messengers would be delivering these, and they would wake up dead in a alleyway. The bonds would be stolen, or the armored cars delivering would be robbed, and the bonds would be disappear, and they'd be untraceable. So you don't really see bearer bonds anymore, at least not in the United States. War bonds. Obviously, it's real famous. In World War II, we issued war bonds, and other countries issue war bonds. And war bonds are bonds that are issued by a government to raise money to pay for a war effort. And many countries do this. They did it in South America. We did it in the United States. The Europeans have done it. And it's great if your country wins the war. The Nazis issued war bonds, and that was probably not a good investment. So if the nation state issuing the bond wins the war, these are good bonds, but they're not good if you're the loser. So, but war bonds have been around for many years. A government bond, we talk about them, they're often called govies, also called U.S. Treasuries. So when we talk about government bonds, we're always talking U.S. government. If it was a foreign government, they call them sovereign. They call them sovereigns. But when someone says government bonds, they mean U.S. Treasuries. Or someone says govies, it's U.S. Treasuries. And that's bills, bonds, and notes. And they're covered by the full faith and credit of the government, right? So those are government bonds. Book entry bonds, that just means the bonds don't have any paper certificate, that they're kept in, there's no physical paper processing. It's all done through computers and book entry form. A serial bond is a bond that matures in installments over a period of time. In effect, a $100,000 5-year serial bond would mature 20,000 as it's like a $20,000 annuity every year for 5 years. Again, these are just terms. I'm just trying to bring out to you the different terms that can be used to describe all these different types of bonds. A revenue bond, this is a special type of municipal bond. This is a bond that is where the bond is linked to a particular revenue stream. So let me give you an example. If the state of New Jersey issues a revenue bond and it's tied to the New York, the Garden State Parkway and the New Jersey Turnpike, then this bond could be tied directly to the tolls paid by the turnpike, right? The tolls collected, right? So in a revenue bond, the revenue generated from the asset that this bond was meant to fund is linked. So the revenue is tied directly to the bond. I mean, you could have a municipality could build a municipal swimming pool with a municipal golf course, and the municipality could, or let's say it was a county, they could build a county golf course and swimming pool, and what they could say is the fees, the revenue that's generated by the golf course and the swimming pool, we're going to hardwire those revenues to pay off this particular security, this bond. So those are revenue bonds. Now, climate bond. This is a bond issued by the government or corporation, corporate entity, in order to raise finances to climate change mitigation and adaptive related products. So all this means is, for instance, if you have a corporation and what they're going to do is they're going to issue a bond that says they're going to use the money from this bond to achieve some goal they set for reducing carbon emissions. You know, re-engineer their factories so that they generate less carbon emissions, or there's some other climate-related thing. They're going to say this is a climate bond, right? Now, the reason why they want to have securities class like this is because there are investors that specifically look out and are looking for bonds that are climate-related bonds that they want to have. They want to have green portfolios. So someone who wants to have a green portfolio would want to add these types of securities to their portfolio. A retail bond, I mean, that's just a type of corporate bond with a low interest rate designed for ordinary investors. You know, this is mom and pop investors are going to buy these bonds, and they're not for the institutional investors. They're very attractive. On London Stock Exchange launched these, and they're just retail bonds, corporate bonds issued for your regular retail investor. Social impact bonds. This kind of ties back to what I was saying before, the climate bonds. These are bonds that are an agreement for public sector entities to pay back private investors after meeting verified social outcome goals with the result of public sector savings and innovative social programs or private programs. So basically, this is where the public sector entities, they could be power authorities, transportation authorities, the MBTA in Massachusetts, or say in Europe, some public sector entities, the nuclear power plants, or that they set a goal for some social outcome goal that can be measured and that they benefit from. So where they're going to do a project that's going to be innovative and help. So that's what social impact bonds are. Contingent convertible. This kind of ties back to what we were talking about earlier about convertible bonds. In a convertible bond, you have a bond that can convert for the investor, that can convert to shares of stock in a corporation, let's say. But contingent convertibles, which are also called COCOs, they're very similar, but in their case, they only convert if some index, some item is reached, right? So, example, a convertible bond, you might have convertible bonds that if the stock price hits X, so if the stock price goes up to X, the bonds or a portion of the bond will convert to shares of stock. Issuing convertible bonds is advantageous to companies than issuing regular convertible bonds. So until an investor exercises the option, the company doesn't need to count the shares in its calculation of diluted earnings. But basically, the point of the convertible bond, the COCOs, contingent convertibles, is until something happens, like a higher strike price on the stock, until you reach that mark, that contingency, that upside contingency, until you achieve that upside contingency, these bonds don't convert. So those are called COCOs. And again, they're geared towards. Most of these are geared towards sophisticated institutional investors. All right, so I guess my conclusion here, and again, I've gone through this fairly quickly, and there's going to be 3 more sections on debt products. This was just to give you a flavor. There's a lot of different factors. There's a lot of different information on bonds and on debt products and debt instruments. And there's a lot of creativity and a lot of flexibility in those products. So there's going to be a lot more. There's 3 more sections on this. So thank you. And if you have any questions on this section, please send me an email at the address listed below. Thank you, and hope to see you on the next video.